Hello, everyone, and welcome back to the Economics Design Podcast. My name is Ari Kimmelman. I'm a research analyst with Economics Design, and today I'm very excited to be joined once again by my colleague Gio Populo and our guest for today, Michael, COO of the DeFi protocol Liquity. Liquity is an interest-free borrowing protocol that has a TVL of around $500 million and has successfully facilitated the lending and borrowing of billions of dollars to date. Michael and Gio, thank you for joining me on the podcast today.
It's a pleasure.
Absolutely. It's a pleasure to be here.
So let's start off with some introductions. Could you guys please introduce yourselves?
Yeah. Do you want to go, Michael?
Yeah, sure. So I'm Michael, as you said. I'm with Liquity. We are a team of 10 people based all around the world. But Robert, the founder, me, I'm in Switzerland. And my role at Liquity is essentially to run the company and create great products together with the team.
Great. And to the people who don't know me, I'm an associate consultant at Economics Design, and I'll be here with Ari and Michael jumping in with questions and doing follow-ups.
Awesome. So today I would like to discuss a couple things. I would like to begin by going over the fundamentals of how the protocol works and then diving into its economics. So Michael, it would be great if you could start us off today by providing us an overview of how the Liquity protocol works.
Sure. So maybe let's start with the user perspective. Why would a user use Liquity? And as I said, it's a interest-free borrowing protocol. So what users usually do, they have ETH and they don't want to sell it because they hope prices will go up or they believe they will go up, but they need cash, for to buy something in the real world or to leverage up on ETH. And that's then when they use Liquity. So they deposit their ETH as a collateral. So it's like a margin loan. And then Liquity gives them a loan in LUSD. That's our stablecoin. So from the functionality, it's pretty similar to Maker, if your listeners know the Maker protocol. But it has kind of three major differences. And so the first of all being interest-free, which I think in itself is a really nice concept. We don't know from TradFi. So we have only a one-off fee, 0.5%. Also really interesting in these times. And then the loan has no maturity. You can keep it open and you have just a one-off fee. Then the other difference to Maker is we have a really competitive collateralization ratio of 110% or a loan to value of 90%, which is really great if you want to leverage up your ETH position. Mm-hmm. And the third one is that we are governance free. So there's no governance drama. Terms and conditions are set in stone. People really know what they get and we can't change it. So that gives them certainty and also provides our stablecoin with unique capabilities. So I think it's one of the most unstoppable stablecoins on Ethereum, like the Ethereum native stablecoin, because it only has ETH as a collateral.
Mm-hmm. Thanks for that. And I'm excited to jump into some of those topics like governance, as well as choosing Ethereum only as a use of collateral. But before we do that, I think it would be great for you to explain some of the details of how the protocol works, such as the stability pool, the staking feature, as well as how the borrowing and redemption mechanism works.
Yeah, so there are different use cases. So the main use case, if you're a user and you have ETH and want to take a loan, you deposit your ETH. And then you, for example, you have, let's say, 1,100 in ETH collateral. Then you can draw a loan up to 1,000 LUSD. You can keep it open but it's really risky if it's just so you have just a tiny margin on the collateralization, because if prices drop, your position might get liquidated. And so what you can also do is kind of then repay part of your loan to have a better collateralization ratio, top up the collateral. These are all the things you can do from a user perspective. Then something different, and sometimes it's a bit commingled, is the redemption. The redemption, that's something every LUSD holder, stablecoin holder can do. You don't need to be a borrower. And that's a feature that was also kind of a differentiator to Maker in the early days, because Maker didn't have a redemptions. So anybody that holds a LUSD can go to the protocol and redeem their LUSD worth to the equivalent of $1 worth in ETH. So this gives Liquity a really nice and hard price floor. And I think that's also a great differentiator for a stablecoin that is so decentralized. I think the peg is quite good because it's kind of almost guaranteed that it's between 1 and 110 because of the properties of the protocol. So we have covered borrow, repaying, redemptions. And there are different functionalities to support the protocol. One thing we already mentioned is the stability pool. So why is Liquity able to have such a low collateralization ratio? That's because in Liquity, loans are instantly liquidated. And that's the role of the stability pool. So the protocol has some funds at hand. So as soon as it needs it, it can liquidate the positions really quickly. Where does the funds come from? These are users that deposited their LUSD and gave it to the protocol. And this is incentivized by the protocol. They receive some native protocol tokens. That's the LQTY token. So there we have a functionality for the protocol. And there we have another token. So LUSD is a stablecoin, US dollar pegged, over collateralized stablecoin. And then you have LQTY. Which you can stake in the protocol, and then you get access to the protocol revenues. So 100% of the protocol revenues goes to these LQTY stakers, and there are two fees. So the borrowing fee, one-off fee, and there is the redemption fee. So borrowing was if you take out a loan, and redemption was if you have the stable coin and just want to redeem the stable coin.
That's very interesting. It's very interesting. I can hop in now. And I think you touched on a point about the 110% collateralization ratio, that like if you do get a loan with that ratio, you're like right on the line to be liquidated if it falls under. And I think there's something very interesting about the protocol that you guys have, which is the recovery mode. And so I saw that on average, the protocol has a collateralization over 200%. So if we get all troves, I don't know if it's around 240, 250%. So it's far off from this 110. But the recovery mode, and correct me if I'm wrong, if the entire average of collateralization in the protocol goes under 150, this is the new minimum collateralization ratio. Is that right?
Yeah, exactly. That's an additional safety measure. So your collateralization ratio of the trove, that's how we call the loan position. In Maker, it's a CDP. There it's like on an account basis. We just look at your margin loan. So that's an individual basis. And the recovery mode, you can think of like the entire bank, looking at the balance sheet of the entire bank and making sure the stablecoin has value. So it needs to be over collateralized, something that's important. Yeah, and so if the entire system goes below 150, we have this recovery mode where then kind of for some period of time, you can also liquidate position between 110 and 150. Yeah, so you need to be aware of that.
Yeah.
But actually it happened, I think, only once or twice shortly. But sure, I mean, people need to be aware of that because then your position can also be liquidated.
Yeah, so that was the follow-up that I had. So let's say that the recovery mode was triggered. All positions from 110 to 150 are immediately liquidated, or do you need an additional action?
Yeah, so in general, independently of the mode, liquidations need to be triggered. Can be and are triggered by people that are watching that, mostly bots. So they're incentivized to liquidate it. And they need to trigger the liquidation, then the funds out of the stability pool, the LUSD is taken and the loan is repaid. And people get then the collateral, the people in the stability pool. So this ensures that we don't accumulate bad debt. The bots get that trigger that liquidation, so they get 0.5% of the liquidated collateral. And by the way, you know, that's also an interesting strategy for the people in the stability pool, because it's like a strategy. So I use it also as a strategy, as a dollar cost average strategy. If I'm in the stability pool, I put LUSD in the stability pool. And usually in times where there is a downturn, liquidation usually happens a lot kind of at the bottom. So there are a lot of liquidations, and my LUSD gets used to repay the loan. I get collateral usually at around 9 to 10% discount, really at the bottom of these downturns.
That's very interesting. So in the case of a recovery mode, the extra collateral that you get could be up to 50%. Is that right? So if you trigger a trove that has 140% collateralization ratio and it's on the recovery mode, do you get the 40% or do you still keep the 10?
No, it's in the 10, yeah.
Okay, that's perfect. And also another thing that you touched that I just wanted to compliment is about the length of the loan. So this is actually the most attractive point for me in Liquity, because you can have your debt for years without paying extra, without paying the same thing as a person who used the loan for one day. So how do you see this, and what's kind of the average behavior of the users there? Do they usually have loans that are long term, or they still want to repay very quickly? Do you have a sense of what consumers are demanding?
Consumer are demanding both things, short-term things, and there it's a disadvantage, kind of the one-off fee, because it's cheaper to have a variable rate. So then users would usually go, for example, to Maker or Compound if you just want to have the loan for a day, for a week. But of course, after 30 days, 1 or 2 months, it gets really attractive to take the loan out with Liquity. Yeah.
Interesting. Cool. I think that really laid out the fundamentals of what the listeners need to understand now, and the details about the protocol as well. So I would like to reference an article that was written by Gio, in which he did a great summary of how the Liquity protocol works, but he also identified some of the risks of using the protocol. So Gio, I think it would be great for you to share some of those risks, and we can get Michael to share his thoughts on them.
Yeah, absolutely. So there are a couple of risks, but I want to touch on 2 specific ones, because I think that, for example, like a flash crash for ETH is something that every lending protocol is exposed to. But specifically to Liquity, something that caught my attention was that one of the risks for any stablecoin is the peg, and we all know that. And there are clear incentives and mechanisms to keep the peg there. We've seen it fall slightly below $1. But what we've seen in the past couple months is LUSD trading 2 to 3% above the dollar mark. So I was wondering, why do people don't just borrow and sell on the market, and why is Liquity having a little bit of trouble by pushing this down to a dollar mark? And if there's any relation to the 110% collateralization, that in the end of the day, if you liquidate a position, that's what your LUSD is worth. So I just wanted to have a sense of your opinion on that. If people are not doing the arbitrage, why they're not doing, and also touch a little bit on the concentration of the stability pool. So how do you see the biggest players, since they concentrate a big portion of the pool, and the risks of them maybe pulling the liquidity out? So I think these are the 2 that would be great to just hear your opinions.
Yeah, let's first take the peg. So as I said, what Liquity is really good is guaranteeing the hard pegs. So kind of the bottom peg at $1, because you can redeem. So I mean, it had times when it went down, but then very quickly it recovers. And the other one is 110, where it's also kind of, you have an ARB trade, and then it's ARBed down. In between, we have soft pegs. So kind of there we say it can fluctuate, and that's because, you have the stablecoin trilemma. And what we optimized for is really decentralization. And then kind of you have limitations in the scalability and in the stability of the peg. So if you need a perfect peg, probably USDC and USDT are better, but there you just take the centralization risk. So these are different trade-offs. So people need to understand that you can't have everything, and that's a bit a design decision. And then you need to understand that the market movement. So usually in bull markets, when there is a lot of borrowing, it's much easier for the protocol to hold the peg, or there is much more supply. And right now in bear market, not a lot of people are borrowing. Because of the tornado cash events, LUSD got a lot of demand because people liked the properties. So right now there's more demand than supply. So that's why it's depegged. And we call it like the resilience premium right now. And as soon as we see more borrowing activity, it should come down. And I think why are people not arbing it? Because it's unclear how quickly that comes. But as soon as it gets higher, it becomes more and more interesting to open up a loan. Because if you then open up a loan for 1,000 LUSD that is worth 1,005, you just got a better loan. Yeah. So does that answer your PEG questions?
Yeah, absolutely. Yeah, I think the other point would be to touch on the concentration of the stability pool. So if you see any risks or how you've seen this behavior like in the past couple of months, if this has been increasing or decreasing, and if it poses any risks in your view.
No, first of all, technically that's totally fine and it's no risk. I mean, it's great to have funds in the stability pool because that guarantees fast liquidations, makes sure the stablecoin is over collateralized. So everything is fine there. And that's a bit, how can I say, why is it like that? Because the stability pool rewards these depositors. And right now still the yield on that is really attractive. So that's why people flock to it. But because these rewards are diminishing, so we hope to see kind of these things being reduced. We also have seen a lot of great integrations. So as soon as a stablecoin is more integrated, can be more widely used, there is more liquidity, kind of these things go smoothen out a bit. Yeah.
So I wanna ask kind of a follow-up question there because we were talking about the market downturn. I would like you to share a little bit about how Liquity managed the market downturn and if it brought to light any important considerations for the team regarding a new version of the protocol or essentially how did the protocol handle it?
Really well. So we're really glad on that side. I mean, first of all, you have seen in the big downturns, DeFi did better than CeFi, the Celsius and so, where there were a lot of problems. All DeFi protocols held up, including Liquity. Then usually in the downturns, all the liquidation and these mechanisms worked really well. And, for example, in the last downturn, we even saw the USDT depeg more than the LUSD. So I think you can always improve, but I think that's the part that has really worked well. Yeah.
Great. And I also want to touch upon something new to the Liquity protocol, which are chicken bonds. Wonderful name. So I'm wondering if you could just share, what are these chicken bonds and why they've been created for the protocol?
Yeah. So why have they been created? So first of all, we wanted to find a way how the protocol itself can acquire some protocol-owned liquidity to ensure liquidity for the stablecoin, which is essential. So that's the protocol view. On the same time, we wanted to make it more fun and engaging to interact with the stability pool. Because the stability pool has a great yield, but kind of it's passive, it's boring. You deposit and you get your yield, all is fine. But I think there are users that want to take more risks, that want to trade the yield or the future expected yield. So chicken bonds opens up a lot of interesting options. So, but it's for more pro user, I would say. And that's what it offers on the user side. But I think the fascinating thing, which we really love about chicken bonds, is this nice blend between DeFi protocol and NFT. We started mixing all these kind of things, and I think that's really a fascinating experiment. So we call it also game theoretic experiment because kind of the rules are clear, but it's just not clear how market participants will behave, what kind of dynamic will emerge. Will there be some dynamic which will allow the protocol to acquire some liquidity? Maybe there will be another dynamic. So that started, and next week kind of the chicken bonds gets into the next phase. And maybe why is it a blend between DeFi protocol and NFT? So there was a technical necessity for an NFT. And we just said, hey, let's make this more engaging. Where else have you kind of an investment, made an investment, and it's also an art piece? So it brings kind of this nice trade-off. Do I optimize for a nice NFT or for my investment? Because during your bonding and kind of going through chicken bonds, what's also really special, the NFT reflects your decision. So we have a dynamic NFT that can change over time. So it's on-chain generative, and it evolves with your decision. At the end, you're not only invested, but you have kind of an art collection that was driven by your investment decision. And yeah, so that's something kind of, we started to work on and now really love the product and see, are really looking forward how it will evolve.
That's very interesting. And actually the NFT part I wasn't aware of. But so I got a little interested in that, in the sense that, do you keep the NFT even after you close your bond? Or is that like a temporary NFT while you have it open? And then once you're done with the bond, it disappears?
Yeah, so I think that's really a world first, how we crafted this NFT. So you get your NFT because it's a bond position, and then it's an egg. And the egg has some random attributes, but also reflects the size of your bond. And then in the chicken bonds, you can make two decisions. Either you chicken out, so you cancel your bond and you get back your principal, so your LUSD. And then the NFT evolves and you have a chicken out. So it's not an egg anymore, but like a little chicken that cracked the egg and is running away. And then if you chicken in, claim your bond and are part of the game, you get a proud chicken. So that's really a chicken which has a lot of attributes, It also takes into account, for example, if you have LQTY, if you have an open trove, if you provided liquidity, and makes then a rarer NFT. So it combines this evolvement of NFT, which I haven't seen, together kind of with taking into account how entrenched you are in the Liquity ecosystem.
Yeah, you're basically gamifying the entire experience of just getting a lending, a loan, and now you have all of these dynamics that like you can interact with. I think that's very interesting.
So I would love to head back to a part of the conversation we had earlier, which is about the governance system or the lack of governance system. So I'm wondering if you could share, Michael, some of the decisions behind excluding any form of governance within the protocol and some of the trade-offs of not having that system in place.
So just for your listeners, I think we are one of the most decentralized protocols out there. First of all, because the contracts are immutable, we can't upgrade anything. So quite similar to Uniswap, because we have no governance. So we can't change any parameter. It's all algorithmically. And so far we are very happy with it. People have the certainty that it works as defined. It lets us focus much more on new product development or education, because you don't need to coordinate. So why coordinate and decide things that can be done algorithmically? So it's like a bank that has no back office, because everything is automated. And then you don't have kind of governance is really takes a lot of time, of resources, of a lot of people, and you should only do it for really important decision. And I think we just saw, why introduce a governance if we don't need to govern things? So I think it worked quite nice. There is some risk or downside. Of course, right now, everything has worked fine. But if it's immutable and you don't get the parameters right, or you have a more complicated systems with different collateral types, it could make sense to have a governance, and things can go wrong and then you can't change it. So that's really a trade-off. And then sometimes systems like RAI from Reflexor Lab, something I really like. They have an on-governance process. So there is governance there at the beginning to tune, to make sure things work. And as they work, they just say, hey, let's remove the control. So it's the complete opposite of a government, which always says, let's add more stuff, we need more people and we do more. But it's making it really more efficient and with kind of less less governance drama at the end. I mean, that's something we've seen a lot recently.
And did you and the team always envision that there was not going to be a governance system in place, or had you guys ever thought about implementing one?
No, I think that's really entrenched in the DNA of this team, mainly driven also by the founder, Robert, because he wanted to make it really decentralized and not, I mean, we're the only protocol probably that has like this full stack decentralization from the beginning. So not only the smart contracts, but also on the front end level, we don't operate front ends. Just to harness the idea of blockchain to take out any intermediaries and central control. So I think always when you think about products, also like chicken bonds, so we always try to make it as immutable as possible and as decentralized as possible. Yeah, I think that's just something we believe in, and as long as it makes sense, we try to stick to it.
Mm-hmm. I think one of the things that I like when I was reading about the Liquity protocol was really its commitment to decentralization, and the fact that it was really willing to, in some ways, sacrifice tremendous growth in exchange for that added level of security and decentralization. And I would say that's really important for a conservative guy like me, who likes to see that level of commitment from the team to the decentralization. And we've seen that in certain blockchains, for example. If you compromise some of that decentralization or security, you can have some serious effects. All right, so Michael, for my next question, I would like to know how Liquity is partnering with other protocols and companies within the DeFi space.
Sure. I mean, first of all, probably we need to distinguish between Liquity, the protocol, which is running on its own, which has been running for more than 1.5 years, issued 5 billion in loans with any kind of support or interaction of Liquity, the company, which has developed the product. So what we can do is, if people reach out, we can educate, help them explain that, and kind of raise the awareness about the protocol. And one really nice example where you see how CeFi could bridge to DeFi was something we collaborated with a broker here in Switzerland, Bitcoin Swiss. And they did a fascinating thing. So they have clients that hold ETH and they give them margin loans from their balance sheet. But because they are not a bank, that's really doesn't scale for them. And what they did, they assessed Liquity and said, hey, why can't we use Liquity? Take the client's ETH, deposit there and give them a loan. So it's for us, it's balance sheet neutral. And how the relationship was they looked at the protocol, we helped them, educated them, but then they integrated it on their own, and there is no agreement between each other because it's a relationship between Bitcoin Swiss and the protocol. So even the end client has as a counterparty the protocol. So this is really showing nicely, and I think it was also like a world first, having a CeFi customer having a DeFi protocol directly as a counterparty, not like with Celsius, where kind of Celsius holds your assets and then it puts it into DeFi. This is just an example, and a fascinating example, what is possible if you're fully decentralized and you have this public good, Liquity, which gives you interest-free loans, and how people can interact with it. And there are a lot of protocols that build now nice products on top of it. We have B protocol that helps stability pool depositors auto-compound their yield. We will see from Balancer the product called Lucy, where they have a vault which invests into the stability pool, but also is a DEX pool, and they manage funds. So this is all is built kind of on top of or around Liquity, and this shows. I mean, that's not something particular to Liquity, but it shows beautifully how this composability of DeFi can work.
So basically, since you guys are like fully decentralized, you don't have a direct relationship with these clients, right? So it's basically like they're developing external tools and resources and mechanisms that can better use the decentralized protocol. So there's the central thing that never changes, which is Liquity protocol, and then people are building things around it to take better use of it. Is that right?
Yeah.
Mm-hmm. I think something else that's interesting, and I was kind of, when I was reading the protocol, was the fact that I still believe Liquity is like far from reaching its like max potential, given how small DeFi is, and the level of decentralization that Liquity offers. Like I know that you said there was about, I think, 5 billion done in borrowing and lending so far, or approximately that. I see some potential for Liquity to take off in some regards over the next couple of years, especially as DeFi grows. Wondering what your thoughts are on the projections of the protocol.
Yeah, sure. I think especially in the next bull market, then when everything expands again, I'm very positive. I also think Liquidity, the protocol, is in a great position if regarding regulation, which will get more difficult and difficult because it's really on the decentralized spectrum. So kind of there are a lot of stable coins that are either fully centralized. So I think the two extremes are well positioned. Either you're fully centralized, regulated, or you're fully decentralized. In the middle, it gets tricky. So when it gets tricky in the middle, so for example, Maker is a bit in the middle, I think then that could be also very positive for Liquidity.
Awesome. That was my last question. Gio, do you have anything you would like to throw in before we end the discussion?
No, I don't think so. I think we hit most of the important points. I'm like very excited to see future developments of Liquity. I'm a potential customer that will probably be experimenting, especially with the chicken bonds. And yeah, I hope everything goes right and we have no issues that would require like a different deploy of the protocol since it's fully decentralized. But yeah, I think this is a very interesting conversation, and it's great to see this kind of project developing, especially during this downturn in the market. Because when things go up, we know that all of this is like going to be worth, and it's going to deliver a lot of value to the ecosystem as a whole.
Mm-hmm.
Cool. Hey, this was very interesting to talk to you.
Yeah, thank you guys for joining me on the podcast today.
Thank you, Michael. Thank you, Ari.
Thanks. Bye.
Bye-bye.
Bye.